The main reason for the double-digit growth in net asset value over the period, probably three of them actually. The first is that we've managed to drive the unrealised portfolio to kind of grow revenues and profits at roughly double-digit in both cases, and that's obviously been hugely helpful. The second is that we've had really very good realisations during the period, and they've been obviously consistent with our history for at or in excess of kind of a holding value, so we've got good uplifts there. And the third is that we've got strong performers coming through from some assets that are strategic. We've got both uplifts in performance and uplifts in rating as well at the same time. I think the driver of that outperformance has been things that we've probably referred to in the past as a kind of J-curve. Often we take businesses we think that are strategically valuable, but they're often businesses that are founder-owned, and when we come on board, we and the founders work to typically put management into the business. So often there's a bit of a excess cost, almost the opposite to what private equity firms typically have, where we invest in the business over the first 12 or 18 months. EBIT may be flat or may even go down for a period of time, but then we hope to get that benefit coming through in years 2, 3 and 4 with improved performance on revenue and improved performance on profit. And if we take examples like JLA or perhaps Ulink or a number of other investments where we've said we've had cost issues where we've invested in the cost base 2 or 3 years ago, we're now seeing superb growth in both revenues and profits in a number of those businesses coming through in 2014, and we believe we'll have that in 2015 as well. We've been active on both the buy and the sell side in 2014 and in pretty equal balance. So we made 5 very good exits in the year, in particular kind of Visma and Manx Telecom and Schleich were very good returns for our investors. We also made 5 new investments from the main buyout fund in Visma and in Ulink, and then also we significantly increased the rate of investment in Mercury Fund, which we're very pleased about and we expected, but it's great to see it come through in businesses such as Allocate and Relay and Sequel. So overall it's been a pretty balanced year, which is kind of how we'd like to see probably 2014 and hopefully 2015 pretty similarly. The main feature I'd say that was slightly unusual but we're pleased about is the amount of capital that we've invested into significant M&A for the existing portfolio. So 23 million invested last year from the trust out of about 80 odd million of new investment. So roughly 25 to 30% went into M&A for the portfolio, in particular for Zenith Lease Drive, for Parts Alliance, and then ultimately for Ulink as well at the end of the year. One of the significant advantages we have from having thought about and invested in areas like technology and in particular kind of software and the web or the internet over a long period of time, 15 to 20 plus years, is that we've seen some of the trends that would appear pretty early on relative to most of our competitors. So software as a service, or SaaS as it's now called, or cloud-based computing is something that we've talked about before, but as a reprise, we've seen investments in that sector in 2004, 2005 and 2006. Our first one that we made directly was an investment in a business called SHL, a psychometric testing business. And we've used those investments and what we've learned from them now 9 or 10 years ago to then make new investments in those areas, I guess ahead of the pack, which we're now starting to see good growth and realizations from, but also to take some of our existing on-premise software investments and to help those businesses to transition to cloud-based computing faster and at a more effective rate than perhaps their competitors can. So businesses like Visma stand out across Europe for being ahead of all their competitors, greater growth in SaaS, a bigger SaaS business than any of their competitors, and that SaaS business continued to grow at a faster rate, rates of 40% plus compound. I think we see the market as towards the top is probably how I describe it. I think the kind of FTSE is at a pretty much all-time high. I think we see levels of leverage and gearing, approaching those levels that we might see at a high. And so overall, we see it as a relatively kind of warm to hot market. That having been said, We think 15 to 20 years experience in our sectors is giving us, I guess, a deal flow and a flow of opportunities from entrepreneurs, from founders, typically, which are slightly off market. And a number of the deals we've completed over the last 12 months have been deals where I think if we'd not got 15 to 20 years history of backing some high quality companies in those segments, we wouldn't have had those businesses brought to us almost as a special investor that the founders or the management were keen to kind of work with. I think the outlook for 2015 is going to be very interesting because clearly the market's at quite elevated levels, and so I don't think we're expecting or would expect to see significant increases in valuation multiples over the period. But to be honest with you, that doesn't really bother us a great deal because the fundamental performance of our investments from a revenue and a profit point of view has come through very strongly in the last kind of 6 to 12 months, as we hoped it would do. And we see that performance continuing over the next kind of 12 to 18 months as well, as evidenced by what we've seen for the first couple of months of the year. So the investments that we've made probably 2 or 3 years ago in management and in systems and those kind of things that we talked about keeping profits relatively flat maybe 2 or 3 years ago has now started to kind of come through in the portfolio, and we're seeing and believe strong evidence that that will continue.